Welcome everyone to today's workshop on how to get your financial ducks in a row. And we have three amazing friends and guests who will be joining us. We have Alice, who's the CEO of myPocketCFO, Ashley with BTR Nation, and Regina from NIMI, and all great founders in their own right. And what we'll be doing is talking about how to manage your finances properly as you are preparing for financing or fundraising for your business, and then also how to manage some of those tricky things around accounting as an e-commerce business and more. So with that, I'd love to pass it over to Alice to get things going.
Thanks, Jordan. Hi, everyone. Thanks for joining this workshop. Super excited to be here. A little bit about myself. I am Alice Zhang, the founder of myPocketCFO. So myPocketCFO is a fintech platform to take care of your financial health all from one place. And specifically, we offer three types of services. One is we automatically takes care of your bookkeeping so that you don't have to spend 6 to 8 hours by yourself doing that, nor do you have to hire an accountant to do that. And second service we offer is real-time access to consolidated business reports or financial reports. So we process all the data on a nightly basis. So you do have access on the next day of all the latest and greatest data in a consolidated fashion to you. And third is we do proactive forecasting and the CFO fractional CFO service. By signing up with myPocketCFO, you get access to we equipped you with the ability to be able to do forecasting, to get access to fractional CFO service advice. We also do referral for you to vendors, partners, as well as investors whenever we see fit. So all those wrapped up in one package from one place, and I hope that will be helpful to you. And a bit about my background really quickly. For the past decade, I have been serving more or less in the capacity of CFO or FP&A, financial planning and analysis, both for startup companies as well as for bigger Fortune 500 companies. And I raised the 50 million VC funding before. I also raised the over 10 million in alternative financing in terms of debt, LOC or sales-based financing before. So, and more particularly, I personally am a food lover. I grew up in the food capital of China. I spent 2 years trying to be a food and bev DTC brand builder. I failed miserably. That was the pivot moment where I realized maybe I should leverage my financial expertise in trying to build a digital version of me to help a broader set of food and bev, or in the extended, I would say, e-commerce brand builders. So that's what brought me and Ash and Regina here today.
Excellent, I love that. And so Alice, yeah, why don't you jump into things for the presentation?
Sure, yeah. So I think for today, the way we would like to go is I would like to just share a really quick rundown of key elements in terms of to take care of your financials if you are planning for fundraising within a year. And then I will pass it to Ashley and Regina to share their experience on how they pretty much, they work with me together in the past, I would say 6 months or so. And I see both of them doing phenomenal. They're on their way to get their investments done. So would love them to share their takeaways, their experiences. And then after that, for the ones who might be more interested on how specific things myPocketCFO can help, I will share a deck about the specific things myPocketCFO can do for you. All right, with that being said, let me jump into a slide deck on the key elements to prepare for fundraising first. So let me start sharing my screen. So I prepared a a short deck to show you, first of all, what are the key elements to get your financial ready so that you can feel confident to go out and start a fundraising. And in my mind, there are specifically 4 buckets, I would say. The first bucket, for most of the early stage food and bev founders, I understand when you started, a lot of you, if not all of you, probably were using cash-based accounting. I would say when you are preparing to get fundraising, especially from institutional VCs, it's appropriate for you to switch from a cash-based accounting method to accrual-based accounting method. And we can talk in a little bit more detail about what does that mean. The second key element for you to get prepared for fundraising is to take care of your cash and working capital management. And what do I mean that is, since you start recording things based on when they occur, based on the accrual-based accounting method, you need to take care of reconciliation between cash transaction and your accrual-based transaction. And I will go into a little bit more detail to explain what specific things are there. And obviously, managing cash runway is a key part of growing and sustaining your business. So actively having visibility and actively managing your cash flow is a crucial part of the second element. The third element I would say is being able to do bottom-up forecasting. Now, when you go out and try to raise money, typically, especially from an institutional investor, typically they would ask you to provide a forecast statement. It could be 3 to 5 year forecast. I think at the minimum, you should be able to do a next year, 1 year forecast. And in terms of the way to do forecasting, I understand many companies out there, they try to do a top-down forecast, meaning I would just assume here is the market share or here is the number of customer I'm going to acquire out of the bat. From my perspective, I would highly recommend you to do a bottom-up forecasting, meaning look at where you spent money from last year or from your history of operation. And from there, figuring out where you put in the most money and where you generate the most output. If we can detect some pattern from your past operation, we can basically use that pattern to map to the future operation, I would say, map into operational handles or levers that you could use to drive your future growth. So that's what I call a bottom-up forecasting. Once you take care of accrual-based bookkeeping, cash management, working capital management, and bottom-up forecasting, I would say as a natural result, you should be able to talk confidently about your financial health, both in terms of explaining what happened in the past, as well as in terms of speaking confidently about what you will be able to make in the future by quoting the forecasting numbers and being able to explain, here's operationally how you're going to make that happen. That's ultimately would be what I like to give the superpower to you. Once you reach to that stage, I'll be very proud of you being able to use finance management as a superpower, right? To make your business success in terms of attracting investments. So that's in a nutshell, the key elements I mentioned about you need to be able to address and take care before you go out of the door and start fundraising. And specifically, let's drill down a little bit deeper. I would say in terms of the first one, accrual accounting, just so you know, the concept of accrual-based accounting is to say we need to recognize business revenue and matching expenses when they're generated, not when money actually changes hand. This means companies record revenue when it's earned, not when the company collects the money. an example, right? So when you issue an invoice to a retailer, for example, or wholesaler, that means you should record your revenue. You could record as accounts receivable, but it will be regarded as a revenue, right? When you get a bill from a co-packer or a vendor, you should record that as an expense. It could be in the accounting term as we call AP, accounts payable, but it's an expense on your P&L statement, right? Even though you don't have to pay the cash, you don't have to pay the bill until next month. But if that expense happens in this month, you should record that. And also when you make a sale on your Shopify website, for example, on your branded website, you should record your corresponding COGS, cost of goods sold. Let's say you sold 1,000 worth of products yesterday. You should be able to record what's the corresponding cost of goods sold of that $1,000 right away. So that's what I call a accrual-based accounting. And then once you are able to record all the revenue and expenses as they happen and as they relate to each other, I think the next step naturally you should be able to take care is you need to be able to reconcile your cash transactions with your accrual-based transactions, which means you need to do cash reconciliation with accounts receivable. For example, when you issue that invoice to retailer or wholesaler, when they pay you in next month, you should be able to associate that cash payment in your bank to an invoice you issued earlier in the prior months. That's what I call a cash reconciliation, right? So that's something your accountant or you should be able to do that. The same approach applies to accounts receivable. You know, you get a bill from your co-packer last month, and this month you paid, let's say 50% of that bill, and that cash payment should be able to associate with the bill you received earlier. That's what I call reconciliation between cash and accrual-based accounts. The second element of managing your cash, apart from reconciliation, is about cash and working capital forecast, right? By doing that, meaning after you are able to reconcile, you need to closely monitor your cash situation. Your cash level fluctuates. And you should be able to forecast because even though you have, let's say last month, you have a high cash level, you have, let's say 50 cash in your bank account, but you have a high accounts payable of 30K in the coming months, which means your cash forecast for the next month is gonna drop significantly. So that's where a cash forecast or a working capital forecast will be greatly helpful in giving you the insight about what will happen in the near future. And that's something I think to give you financial superpower, you should be able to do that through a cash forecast. And a related topic with cash management would be, if I forecast my cash going to dwindle or drop significantly in the near future because of a huge order on the inventory or a big bill payment, you should be able to think ahead of time about different channels to get alternative financing, right? Such as inventory, financing, bills financing, any other debt-based financing, or it could be revenue-based. I know, like Ashley, I know she gets like a Shopify Capital cash advance because her Shopify sales is growing rapidly. So as long as you have the capability to forecast about your expense and about your potential revenues, you should be able to plan ahead of the time, I would say, to get the alternative financing so that you make sure you have constant inflow of cash. Cash is kind of like a block, right, to keep your business growing and keep your business running, right? So that's the second element. The third element is bottom-up forecast. So I want to explain in more detail what is bottom-up. So a top-down forecast offers a prediction of how much market share is needed, while a bottom-up forecasting offers an understanding of which business activities have the biggest impact on your financial performance. So if we do a bottom-up forecast, we will be looking at, we'll be scrub your operation details, and we'll be look at, for example, what's your sales by channel of last year? What's your expense by vendor or by specific category? And we will be able to really do some deep analysis and figure out what are the channels or categories where you spend, where you have the biggest buck per return, right? And then we will be able to map that pattern, hopefully, to the future operation to kind of inform you in the most effective way you can operate for your future business growth. So with that being said, once you take care of all those three elements, the other thing is, by accessing to fractional CFO access, like being able to talk to me anytime, I hope to basically be able to advise you on more strategic financial decisions, like for example, which vendor you should choose to go with the alternative financing, or when you talk to a institutional investor, what should be the things you talk confidently and you promote in terms of your financial strength, what kind of things you should be aware could potentially you could potentially explain, proactively explain on some of the numbers might be perceived by investors as a weaknesses. So ultimately, my mission is to help you to gain financial superpower, so you can talk confidently about your numbers anytime, anywhere, and that sets you apart from the rest of the pack when you go out do the fundraising, as well as running your company. And with that, I'm gonna stop share, and this is a little bit of knowledge sharing, and I'm gonna pass it to Ashley and Regina to share their experiences on how they take care of those key elements. Ashley, you wanna start first?
Sure, I'll dive right in. So Alice covered so much about myPocketCFO and about the services that are just so valuable. So I'm the founder and CEO of BTR Nation. If anyone knows BTR Nation or myself, you know that my expertise and what I love doing the most is sales and marketing. So I have always thought of finance as like, let me go into QBO, let me put some journal entries in, let me do all my bookkeeping myself, until Alice and I really sat down and really took a look at our books. And they weren't too bad, right, Alice? They were pretty clean, but I wasn't able to tell the story and get the metrics that I needed to begin fundraising. So we kicked off our seed rounds at the end of 2021. We're currently in the process. We've already raised a bunch of capital from angels. We just kickstarted our Republic round earlier this month. So all of that is because of the due diligence that Alice and I were able to do together. So really building that bottom-up forecast was incredibly helpful. Being able to tell the story about these key metrics and have all the data really at my fingertips, because I would just sit in QBO and essentially, spend like 6 to 8 hours every other week reconciling some things and being like, okay, here's my P&L, here's my balance sheet, I'm good to go. But not really being able to take a closer look at sales by channel, not being able to take a closer look at our repeat customer rate. So that's something, we have a repeat customer rate of almost 45%. That is a huge metric that is so valuable in the storytelling aspect to investors, to partners, to retailers, and being able to really pinpoint our numbers and just create this whole narrative has been just so helpful and a time saver. So for me, I'm very frugal and conservative with our capital because we are so lean, and we're basically a one-woman show at the moment. So really being able to have Alice as a resource and as our fractional CFO has just been so incredible, because we just have all of the numbers and all of the advisory services. So we also use some alternative financing options as well too. So we use Shopify Capital, And although we're migrating away from that and using Wayflyer full-time as our alternative financing option. And Alice and I built this entire treasury essentially of every single alternative financing option on the market. So whether that be a QuickBooks loan or a PayPal loan or payability, Clearco, like everything, we covered all of our bases, pros and cons, and figured out what terms look like. Like that's the type of personal customized service that you get. So I can't speak highly enough. So I've got lots of things to share, but I'll let Regina share her experience as well.
Hi, everyone. Thank you so much, Ashley. My name is Regina, and I am the founder of Nemi Snacks. Our mission is to elevate Mexican cultura through real and authentic Mexican-inspired snacks with a sombrero-free branding. And I just agree with pretty much everything, Ashley, that you said. When I started the business 3 years ago, I was using all these different tools. I started using QuickBooks. Personally, I don't like QuickBooks. I don't like how you navigate all the information, but it wasn't really user-friendly for me, and it wasn't information that I could have readily available. So I ended up it was the end of 2021, and I had 7 different spreadsheets where I was tracking everything to a point where I was doing it, but it wasn't manageable. And the way that I was seeing it, it wasn't sustainable either. So that is actually when I went to you, Ashley, and I asked you if you worked with anyone that could make the process more efficient. And if there was something that I could find where I could just get the information that I needed, first for myself, because I just wanted to know that information, and then for the pitches that I was doing or the conversations that I was having. And so I think it was always going back to this question that as entrepreneurs, we usually have how can I make this process more efficient? And knowing what we're not good at. So I knew that finance wasn't my forte. I knew that it took me significantly more time than maybe a numbers person to go through my numbers, to review all my 7 different spreadsheets. And then Ashley introduced me to Alice. And the moment that we had that first conversation and I met Alice and her team, there were several things that stood out for me, and the reasons why I would recommend myPocketCFO. The first one was that I could tell right away that they had knowledge of this space, and that they knew what they were doing. And I was coming from having knowledge of this space according to my experience in the CPG world, but I knew that there were so many things that I didn't know, and I knew that I needed to partner with someone whom I could learn from and get that all the information that I needed to have, but I didn't have the understanding at that moment. The second thing was how user-friendly the software is. The moment that she gave me the presentation and I was like, oh, so it's only like four different tabs where I just need to see all the information. And actually you only see, and you will only pretty much have access to just the information that you need. There's so many things, I think, in my experience in QuickBooks, or even the spreadsheets that I was using, where there was a ton of information that I wasn't actually using and that wasn't even necessary. And I think with myPocketCFO, it's just really the information that you need to know and what you will need. The good thing about that also is that as myPocketCFO starts learning about your company, you start optimizing. So like going back to what Ashley, you mentioned about categorizing, it automatically will categorize a lot of your transactions depending on the expense that you have and how you're using and categorizing those expenses. So it's even less time now than when we started working together back in January, earlier this year. The other thing that I really appreciated is they will work with you according to where you're at with your business, considering the background of your business. So I started working with myPocketCFO in January, but one of the first things that Alice told me was, I need to be able to see everything from day one. So we pretty much transferred all the information into myPocketCFO since late 2019 when I launched the business, all the way to the day that we started working together. And you have the whole picture of your business in one same space. And then with that, all the projections for your business, depending on the path that you want to take with your business, what's the road that you're going to take? And based on that decision, the information that you need. And that is actually something that we're currently working with based on the projections and the future of the business. And I think the last thing, which is not, the least important thing, is we always hear people saying, nobody's going to care about your business the way that you care about your business. And that may apply in some areas, but it doesn't feel like that with my Pocket CFO and with Alice and her team. They're really responsive to the point where sometimes I have to tell them, you don't have to respond on a Sunday morning. It's okay. Like I might be sending emails on a Saturday evening, but you really don't have to respond to me within the hour or anything like that. So it really feels like you're not alone. As you know, I'm a solo founder as well as Ashley, and it's a very lonely road sometimes. And it really feels like they're part of your team. They're invested with you. They explain everything to you. Another thing that I really like, and it's very important as an entrepreneur, especially if finance is not your stronger suit, is they explain to you how they're doing it and why they're doing it. So you don't have to, you don't get the information saying, where did this come from? How am I going to use these numbers? If they ask me A, B, and C about this transaction, what am I going to say? They explain, you will understand how they're doing things. You will have control of the information. I mean, it's so user-friendly to the point where you will know what you're doing. You will know at some point what's important, what's not. They will continuously flag some things that maybe you not be aware, that you just have to be aware of how you're doing things. And 5 months into working with myPocketCFO, I really understand in a way that I didn't before. I knew my numbers and I was always very diligent because I knew, again, it wasn't really my forte, but I understand it in a way. I can confidently talk about it pretty much from day one and how we're going forward. So, just echoing what Ashley said, I cannot recommend her enough. Like sometimes I tell her, I don't want to recommend you that much because, but I really think that it's a very, very helpful software. I'm continuously impressed about how we're moving forward and the level of expertise and how organized we are. And this is something that I've shared with other people, and people have responded with very positive feedback saying, like, you really have a good, how do you say it in English? Like, I mean, not understanding, but a hold of your numbers. And that's really much thanks to myPocketCFO and Alice.
Wow, I'm so moved. With both of you, Ashley and Regina, I would never have expected such a strong endorsement for myPocketCFO and myself. I just want to emphasize or echo one point is, I think the mission of myPocketCFO and myself in building this tool is really what I call empower or enable the founders to basically use finance as your own superpower. That's why educating, educational, making sure as a founder you understand exactly why we're doing this, why we're assigning this category to this transaction, and why we're doing this kind of forecasting. Is really, really important. It's core part of myPocketCFO's mission, is to make sure we equipped you and yourself, the founders, with, it's kind of like we give you an armor of like Iron Man's armor for financial management, because I believe that's the only way you can do it, because you are the one who goes in front of investors, partners, and customers to present, this is how you're going to do it. And financial management is such important in any of the conversations. So it's not the job of the accountant or not the job of a financial analyst or even CFO. It is you. So we have to educate. We have to be totally transparent and show you why this is important and why we do this, do that. So thank you.
I have a quick question. I'd be curious to know from Ashley and Regina about when you transitioned from doing your kind of finances yourself, what were some of the biggest things you were doing wrong that you found that were much better when you started working with doing your finances correctly?
You mean the early days of myPocketCFO versus now, or just
no, for Ashley and for Regina, for their businesses?
Oh yeah, I can dive right into that. So for us, I was probably, I for sure was using cash and accrual based interchangeably. So that was a little bit confusing. And I, like Regina, also had, I don't think I had 7 spreadsheets, but I was getting there. And I think that was the biggest takeaway now is I literally I check myPocketCFO once a week and reconcile everything for the week. It takes me 15 minutes. And before that, I was doing things and trying to figure out which chart of accounts, which category, like, do I need to create a new category for it? It would probably take me about a couple hours a week. And so it saved me all that time. Plus, I was probably doing some things wrong because we had to re-reconcile things that were once cash-based and should have been accrual-based. And that can be super confusing for top-line revenue, for profit, and, as going in front of investors, making sure that you know everything. Or you can literally just log into myPocketCFO, and like Regina said, the dashboard is just so easy and so user-friendly and intuitive to understand. You can get your top-line revenue, your profit, your accounts receivable, your payable, everything in like a minute. So, but I think that was our biggest mistake, was doing cash and accrual based together and not really fully understanding the impact of that. So we had to re-reconcile a bunch of things for 2021, which was our first year in business. So.
Yeah, I think, very similar to Ashley as well. I was doing it cash based. I was not categorizing correctly. I thought I was, but I actually wasn't categorizing correctly. So that was causing some issues with my finances. And I think mostly I think the biggest thing for me has also been kind of the projection and the future of the business, where I was looking so much at the past and the present, but it was hard for me to consider everything that I needed to consider that I just didn't know by myself. I just didn't have the information or the expertise that I needed to consider the projections, and based on those projections, the path for the business, right? Their company is still bootstrapped. So just thinking about what, how are we going to move forward, depending on our goals and what we want to try to achieve, what is it going to be the road that we're going to have to take? But not only that, how can I take it in a responsible way and in a way that it's going to be that is going to actually work depending on our end goal. So I think that's been pivotal for the business. And that's where really Alice came along to provide that knowledge and information of, oh, this is what I needed to know. Like, this is what, and I think I didn't know why I sometimes didn't feel confident and felt insecure providing that information, but I knew sometimes I was coming in with that lack of information. And there was like I was already coming in kind of insecure into the conversation. And that is totally different now. Like I know with the numbers that I need that I'm coming in, and that has made a huge difference with the conversations that I have with advisors, with potential investors, et cetera.
Yeah, it reminds me of actually with when I was running T-Squares, we were booking inventory into like cost of goods sold when it arrived instead of actually booking its inventory. And so it definitely, although we were using accrual bases, we're just doing it incorrectly. And we were basically like never holding inventory on our books. It was going straight into cost of goods sold, which just gives you a messy picture of your business because we like kind of knew our costs. But I think, for us as well, we're trying to say, hey, maybe if we do it in that way on the profit and loss, we can just see all of our like expenses, like cash expenses and our cash revenue, but it was blending like a cash accounting system with a accrual system, and it started getting real messy as well. So that was something that I kind of learned from the finance process that I had to clean up myself.
Totally agree. Yeah, I remember the early days. Ash and I, we have to, again, I see that's part of the education journey, with the founders is sometimes they're not necessarily crystal clear about what's the difference, for example, between cash and accrual basis. So once we kind of do those exercises together, it will be, so much clearer, so much better. And Regina, I remember, I think to some extent we're still working through some of the invoice reconciliation, right? We're working through a lot of those. I think fortunately, from my account team, we have a really, I would say, capable CPA. My partner Eric that's where I think this might be a good point to share what specific myPocketCFO does, because I think we offer automation software to take care of your finances, but we're not just only that. On top of that, we also offer the real human subject matter experts or expertise. Eric is really the CPA, and he really actually examines and makes sure your bank account and your MPCFO, myPocketCFO or QBO are all 100% reconciled. And he's a very good CPA. If small things doesn't reconcile, we actually would get back to the founders. That's where, sometimes we would actually send emails over the weekend to the founders. So we do care all the founders get the most accurate, most robust P&L you can get in a timely fashion. Yeah, so with that being said, maybe Jordan, is it a good time? Maybe I'll just probably spend 5 minutes or less to walk through a quick slide deck on what myPocketCFO does.
Well, I'd say this, Alice. I know we have a bunch of questions. Why don't we save that to
Yeah.
the end and jump into
Sure.
some of the questions? Because I think
Sure.
a lot of founders have some of those. So Mark has a question. If Mark, you want to jump up on screen, and then someone chatted me a question as well.
Hi everyone. Thanks so much for the talk. I just had a general question about capital raising. Are you able to talk about from like the investor's perspective, what the due diligence they're looking to do is? Are they looking for like audited financial statements? Do they want tax returns? What kind of metrics they're looking for? I think Ashley mentioned like sales by channel and customer, repeat customer rate. That makes perfect sense. Just would love to hear any thoughts on that.
I think, Ashley, you might be the best person to answer first, and then I will try to chime in. How about that?
Sure, absolutely. And we're still learning every single day. This is thank goodness for Alice, because not only getting our numbers together, just the confidence, being able to sell your product is very different, especially in the current market climate we're in right now, going to people and asking for money. So I'm still learning every single day. But for us, we had a few different types of due diligence. Really, what I'm learning too is that it differs so much across investors. So we're not seeking institutional capital right now. We're seeking really just angel investors, went to a couple micro funds as well. And then we are raising on Republic. So the due diligence for all of that was so different. So for one of the micro funds, we actually had to put together a bottom-up forecast from the 2022 to 2025, which was pretty, Alice, I think that was like a little intense, but we did it. And it's really so helpful, because it's incredibly helpful for myself, because I can really plan, especially with R&D and innovation, and really start looking into, I was forced to put this together, and I can really look into like 2024. 2025 is, I think it's a little tough to really forecast that accurately 3-4 years out, but 2 years out, we're really able to see a full landscape of the business, which is cool. And then Alice and I put together really the key metrics for us is like, what are your strengths in the business? So I'm trying to think back to the due diligence process. And I think a lot of investors are, they're asking for your burn rate. They're asking for how much runway you have. They're asking, I don't think we didn't have to do any like tax returns or anything, but what we did do is we put this whole data room together. So in our data room we used Notion, and then we used Google Drive to put all of these documents into one place for the investors to look at. So that included for past P&Ls, future P&Ls, org chart, like right now, solopreneurs, literally there's one person on the org chart, but what does that look like 3-4 years down the line? Our pitch deck, I think I'm on version 74 of my pitch deck. So all of those things together compiled into one data room, and just to make it nice and easy to share. Trademarks, anything like that goes in the data room as well. And then Republic was a whole due diligence process too. So that's why I love Republic as a platform, because they take a look at all of your P&Ls also, but then they ask you a bunch of different questions where you need to obviously have your numbers ready too. And I don't remember it off the top of my head, but if you if anyone wants to talk more about Republic, happy to do so. We've only been on the platform for a little under a month, so but happy to share more about our experience. But those were the general things that our investors were looking for. And I'm sure when you're raising institutional capital, it's going to be much more intense, and there's going to be several rounds of due diligence. But for us, that was really what our angels were looking for.
Actually, were the angels actually asking you about like going through your P&L and your balance statement, or were they really just looking at like your revenue projections and just wanted to know like the top line numbers?
Yeah, I think that the things that people they didn't really dig too deep into it. I think it was because I do think like seed round, right? Like I think a lot of times angels are excited, they're writing usually somewhere between 25 and 50K checks. They want to know more about your business, the mission. Like they're coming in, and all of our angels are in the CPG space, so they very much understand what that looks like and what investing looks like into a CPG company. But it was top line revenue, and also path to profitability. So for us, like we're year to date, we're profitable, so that's a really important metric. Will probably change as we're launching a new product line. So all these things, R&D and innovation is really what we're raising for. So that's going to be fun in the next couple of months. But that was really important, is like knowing your point of profitability. That was also very important for Republic as well. So that's kind of what the angels were looking for, like top line, bottom line, and what's new, what's exciting, what's coming down the pipeline. And they want to see more about the future. And we did actually, 65% of our business is D2C, but our angels actually also are really excited to know like what doors are we opening, where are we going next, like what's our omni-channel strategy, etc.
Yeah, and I want to add on top of that is I think out from the start, to support a founder or startup to raise money, obviously we're targeting institutional investors eventually. So what we need to prepare, number one is we will help you to prepare a data room. And understanding that in that data room, the investor, especially institutional investors, going to ask you to drop a bunch of things. Some of those facts or documents are, hygiene, kind of like check the box related, like your incorporation documents. So they know, like they do a validation on who you are you who you are saying you are, those kind of thing. Bunch of legal documents, formation documents, your investment, your shareholders structure so far, right? Like who are the angels who wrote the save to you so far. So a bunch of those categories of information and documents you have to prepare. And then specifically related to financials, typically it would involve your history of all your financial statements, your P&L, balance sheet, cash flow. I would say at least for the past, a year or two, if you are fairly new. And then forecasting, typically, as I mentioned, you have to have a forecasting financial statement. Many of them obviously focus on the growth, right? But I would say even you focus on the growth, there are a lot of nuances that comes with a growth forecast. For example, like in Ashley's case, she's an omni-channel brand builder. I believe majority of the DTC or e-commerce brand builder now, right out of the bat, you are omni-channel by default. So you have to be able to show and explain which channel is your main channel, which channel might be coming down the road, and what's your channel strategy. Are you a true omni, or you're more focusing on DTC, and maybe later expand? I remember, when Ashley and I worked together, she definitely has an edge on the Shopify DTC channel, but she planned to expand aggressively in the retail channel. And I remember one version of the forecast is like a super aggressive expansion on retailer, which raised the question of, are you, what's your strategy? Are you, do you want to be more of a omni multi-channel, or do you still want to stay as a main DTC brand? So those kind of, I think those are more strategic questions the founder has to think through ahead of the time so that they can answer those questions when investor asks them confidently. And what myPocketCFO and a finance, a CFO can do to support the founder is we really have to work collaboratively. If the founder saying my strategy is still to be a DTC brand builder, but complemented by retail channels, then we need to tweak the forecasting model in terms of sales growth by channel to reflect that strategy explicitly so that you can go out and talk I would say a clear storyline of this is how you're going to carry out your strategy and this is your forecast that's going to support your strategy. So I think that's the key element of what we can be of help here.
The last thing I'll just add, Mark, as well as having gone through financing, is that think about your financial model as a story, and you want to make sure that story is supported with the numbers that you want to tell, and to share the real information, but be specific on which information you share, because you don't have to share every little detail to the investor. You can kind of choose what you want to share. Because I remember we showed like monthly sales, and then grocery goes like up and down. And then we had an investor like, why did your sales go down in August versus in July? I'm like, well, the buyer was out sick for Whole Foods, and it just became this really nuanced conversation that we didn't want to have. And so the data that we show on a monthly view obscured the story, which we later changed like a quarterly view, which evened out some of the monthly trend lines. And so a lot of investors will look at like the profit and loss statement and things, but they're looking at those as like red flags, or that you're doing it wrong. But they're really listening to like the story that you're telling.
Absolutely.
We got another question in via the chat. And Alice, let me know if you're going to answer this one. So a founder received advice that you should track revenue via your wholesale case cost and bring distributor margin and deductions below the gross revenue line for trade spend. But they said that didn't seem right. So the question is, how do you properly document your like wholesale revenue on your accounting documents, and where do you put things like trade spend and distributor fees?
So to start with, as I mentioned, we track both sales COGS by channel. That's I think, for example, with Ashley and Regina, when we start setting up your accounting book and your company's specific chart of accounts, I think that's where we basically try to learn what are the key characteristics of your business, and then we will set up appropriate or separate chart of accounts and categorization just to capture the differentiated way of both revenue and expenses. So we can set up, so for example, Ashley, we set up as sales by Shopify, by Amazon, by offline channel, and by other channels. So we can set up specific way by your specific channel, and we can allocate cost to your specific channel as well. I hope that answers the question.
And I can chime in too a little bit, Jordan, because Alice and I actually created a new chart of accounts in our expenses section specifically for trade spend, because we launched into some regional retailers in Q4 of 2021. And I was just tracking it as advertising and marketing. And then I was like, this is not helpful. It's not nuanced enough, because I'm putting it in, our demo is $100 a demo or something like that. I was putting that into my advertising and marketing spend. And I'm like, I need to see how profitable these demos are. Like, are we breaking even? How much are we losing on them, et cetera? So then in Q1, we actually made this new chart of accounts, which has been really helpful for me to be like, yeah, we're probably overspending a bit on trade spend, and here's where we need to pull back. And here's where we can, spend more on influencer marketing or something like that. So really getting very nuanced was very helpful. And then Alice and I are starting to work on distributor chargebacks. We just got our first chargeback. So now we have to like go into and take a look at what that's going to look like on invoices and how we account for that in myPocketCFO. But I highly recommend separating trade spend out from other advertising and marketing expenses.
Yeah, I know a lot of founders or brands will, or accountants will say, you know, book your, like the actual money that you're expecting from the distributor, and then you can book any expenses or chargebacks or deductions as contra revenue, which is essentially like a negative spend within your revenue since it's within there, for things like you know, fees or spoilage, and then put like marketing spend as a different line item. If it's like a marketing trade spend or promotion, that can go to a different place. But I also know some brands go really detailed and have like every single line item for deductions, but sometimes that's not manageable or helpful either. So you have to find the right balance of detail. And then Dan had a question. He asked, any insight into sharing financial projections for investors and having a healthy balance between conservative and optimistic potential for growth?
I think typically we could do a baseline projection, and we could do optimistic scenario and downside or worst case scenario. I think that's again, Ashley, I don't remember if we ever did that or we just did one version, but that I think really depends on the specific investor you're talking to. Obviously, also depends, like right now, given the macroeconomic environment, overall is downturn, it's in a more of a downturn environment. You may have to pay special attention to your profitability, for example, versus previously a forecast could be more about growth story. Now it could be growth plus profitability story. So it varies. Oftentimes, again, it's a strategic call or strategic discussion that we have to collaborate with the founder to set the strategy first. And then we can go ahead to tune the forecast model just to support the strategic direction the founder wants to take.
Yeah, I think, Alice, what we did with my forecast, and I'm tweaking it as we go as well, and because it's a living document, is we built this baseline of where we want to be and where we realistically think we can get to, and then I built basically the conservative underneath it and then an aggressive on top of it. So basically, layering it and being able to, because forecasts are constantly moving. In my experience, I'm super realistic, and in all of my investor conversations, I think that's been, getting us really far, of being really honest, having a very realistic valuation and a very realistic valuation cap. I see sometimes people enter the market and then they have a valuation, they enter the market or they're pre-revenue and they have a valuation cap at like $11 million. And it's, you don't even have product market fit. So I think that being realistic, especially in this climate, is what investors want to see, specifically in CPG. I know tech is very different, as Alice and I talk about all the time. But I think that it's important to be realistic, but also showcasing, like, here's where we're going to be conservatively, and which is in all the conversations I have, and here's where we're going to be aggressively if there's, no additional supply chain issues, no additional inventory issues. Like, here's where we can get with your capital. And I think that's also another important thing, is like knowing what your pre-money valuation and your post-money valuation looks like, because that's going to be different. If you're able to, raise your full round, you might be able to hit that aggressive forecast a lot sooner. So just being mindful of how you're building your forecast. And I recommend building like that baseline, and like, this is what I'd be happy if we hit. This is what I'd be like, it's okay. It's manageable. We're still seeing growth. And then this is where we like aggressively want to go to. So those three forecasts have been pretty helpful for us.
And actually, you mentioned a really important thing with investors, which is trust. if you are constantly putting out forecasts and never meeting them, then they're just not going to trust you anymore, right? Like it helps at the beginning when they're like, oh, this could be a, $50 million business. And then when you're constantly underperforming, they might write you off versus if you set conservative expectations, once they're in, especially, they might not be as like, ooh, exciting, but they will be once you start saying like, hey, we're 20% over our projection. That sounds great, and that's like a really good spot to be in. And so, yeah, it's tough for, when you're doing those projections because you want to be really aggressive, but be reasonable too.
It's such a tough balance because then you also talk to investors who really want to see that hockey stick growth. And it's as long as you can show like, this is with your investment, here's where I can get the hockey stick growth. But the reality is without that additional capital coming in, it's very, very challenging when you're constantly, taking those revenues and putting it right back into the business. The growth might look a little bit different than a company that's raised $10-20 million. So it will definitely. So I think it's so hard to balance, but I think having that realistic forecast is going to be so important for yourself and to build that trust. And it's also because you'll be able to meet it as opposed to like what Jordan said is under deliver.
Yep. I know we're at the end of our time. Mark, did you have one more question you want to ask real quick?
Yeah, no, I mean, on the same point, it's an interesting one, right? Because I guess my question is, what kind of returns are VC investors looking for, right? Because you can, if you present a conservative estimate, and like a lot of VC investors I talk to say you should be like they want to 10x their investment, right? So if you present that you're a $5 million valuation today, you obviously have to demonstrate you're worth $50 million by the time they want to, exit their investment. So presenting in projections that even though they may be more accurate, that don't, assume that you're pretty much precluding yourself from fitting in there, So I guess the question is, are food and beverage investors looking for different returns than that, or am I off base?
I mean, I can just say what I've experienced, and anyone want to jump in real quick. But there are investors who are looking for 10x, but you also have to be, and they're realistically expecting most of their investments to fail. So they want to make sure you have a path to potentially get there. But you also have to believe that you can get there. If you're looking at your numbers and like, you could probably do like 5x, and you're telling them 10, you're just going to disappoint that relationship later. But if you genuinely believe that you have a path to get there, then that's the path that you need to pitch, figure out what money you need to make that happen in order to make that work. But it's different if you think you can get there versus if you don't think that you can get there.
And I think that's where that bottom up forecasting was so helpful for us, because I've done forecasting at a previous company, and we did a lot of top down forecasting, which is just making a lot of assumptions. And I mean, forecasting in general is just making assumptions, but building bottom up and really being able to showcase, like, here's where the capital is going to go. Here's where we can have additional personnel. Here's where we can have additional advertising and marketing. We know that we're already seeing this, hypothetically speaking, a 2x ROI on advertising and marketing. So we know that this is how much our Shopify channel can grow if we're getting this infusion of capital. Being able to show them that has been helpful to building the aggressive forecast. So, but like I said, I'm like brand new to this as well. And it's challenging because you really have to believe, and I'm trying to actually like get together founders, and Jordan and I talk about this all the time. I'd love to understand and know more about the founders who exit or who, get to between that like $20 to $50 million in revenue, what that looks like and what their next steps are. Because you really just hear about people who, you hear about food and bev businesses that go out of business. Then you hear about food and bev businesses that sell for 100 million plus. And there's like not a lot of transparency about what happens in between and what are investors looking for. So, I mean, every institutional investor I've spoken to is also looking for, I think, like that 8 to 10x, but with angels, it's so different. So that's why I highly recommend starting with them, because I don't want to say their expectations are lower. It's just that they understand the space, and it's more of a passion project for them, and being involved and being brand ambassadors for the brand is very important for them, as opposed to just like an automatic 10x return.
Perfect. Well, thanks so much, everyone. And thanks, Ashley, Alice, and Regina for the presentation. I know we're a little bit over. As I mentioned, I'll be sending the recording of this presentation on Monday, and also with information on how to get in touch with Alice and my CFO if you have any other questions or you want to see what it's like working with them. So thanks so much, everyone. Have a great weekend.
Thanks, Jordan. Thanks,
Thanks,
everyone.
Jordan.
And